Ladies and gentlemen, something just broke in the global financial system, and it did not break quietly. Japan's 30-year government bond yield has surged to 3.5%, a level that would have been unthinkable for an entire generation of investors. For decades, Japan was the anchor of zero yields, the foundation of cheap global leverage, the silent engine behind carry trades, asset inflation, and financial stability illusions. Today, that anchor is lifting, and when the anchor moves, every ship in the harbor feels it. This is not just a Japanese story, this is a global margin call unfolding in real time. The surge in Japan's 30-year government bond yield to 3.5% represents far more than a routine fluctuation in interest rates. It marks a decisive break from a financial regime that has shaped global markets for decades. For nearly a generation, investors operated under the assumption that Japan was structurally immune to rising yields, protected by deflationary psychology, demographic stagnation, and an all-powerful central bank committed to suppressing long-term rates at almost any cost. That assumption is now being challenged, and when long-held beliefs collapse, markets tend to reprice risk with speed rather than patience. This is why the move matters. It signals that the era of guaranteed cheap money is no longer a credible baseline. Long-term yields are not driven by short-term policy tweaks or temporary sentiment swings. They reflect deep expectations about inflation persistence, fiscal credibility, and the real value of money over decades. When investors demand a 3.5% return to lock up capital for 30 years in Japan, a country long associated with zero inflation and near-zero rates, it suggests a fundamental shift in confidence. The bond market is quietly asking a difficult question. Can monetary control really override economic reality forever? That question alone is enough to unsettle a system built on stability narratives. Here is the critical hook most overlook. Japan's bond market has functioned as the world's volatility suppressant. By anchoring yields near zero, it allowed global investors to stretch duration, leverage, balance sheets, and chase returns with minimal fear of rate shocks. Once that anchor starts to rise, even slowly, the entire pricing structure of global assets begins to wobble. Valuations that once made sense under zero-rate assumptions suddenly look fragile. Risk models, calibrated to decades of suppressed yields, no longer reflect reality. What makes this shift especially powerful is its psychological impact. Markets are not just responding to high yields, they are responding to the realization that a policy once considered permanent was, in fact, conditional. That realization forces investors to rethink time horizons, discount rates, and capital allocation decisions across the board. Pension funds, insurers, and sovereign investors, institutions that live in the long end of the curve, cannot ignore a move like this. They adjust, and their adjustments move markets. The deeper implication is that this is not a Japanese anomaly, but a global signal. When the longest dated debt in one of the most stable economies reprices higher, it sends a message that inflation risk, debt sustainability, and policy limits are being reassessed everywhere. This is how regime changes begin, not with panic, but with a subtle shift in expectations that slowly dismantles the old rules and forces markets to operate under a new, less forgiving reality. But for decades, global markets have quietly relied on Japan as the cheapest and most reliable source of funding in the world. The yen was not just a currency, it was a financial tool, borrowed at near zero cost and deployed into higher yielding assets across the globe. This strategy, known as the carry trade, became so deeply embedded in the system that it stopped feeling like a trade and started feeling like the permanent feature of modern finance. That illusion is now being challenged, and when a trade becomes crowded, its reversal is rarely orderly. As Japanese yields rise, the basic math of the carry trade begins to fail. The spread between borrowing costs in yen and returns on foreign assets narrows. While currency risk increases at the same time, a strengthening yen turns what once looked like steady income into potential losses overnight. This is the hook investors often underestimate. Carry trades don't unwind because participants change. They unwind because the risk profile flips suddenly. What was once low-risk leverage becomes high-risk exposure, forcing rapid repositioning. The scale of these trades magnifies the danger. Trillions of dollars worth of positions across equities, bonds, emerging markets, and private credit are tied, directly or indirectly, to cheap yen financing. Hedge funds, global banks, and institutional investors structured portfolios assuming Japan would remain an endless source of liquidity. When yields rise, margin requirements increase, hedging costs climb, and funding lines tighten. The response is mechanical selling, not strategic allocation, and that is how volatility spreads faster than fundamentals. Another underappreciated dynamic is currency feedback. As positions unwind, demand for yen rises, pushing the currency higher. A stronger yen then accelerates the unwinding process, creating a self-reinforcing loop. Each step strengthens the currency further, increasing losses for those still holding carry positions and pulling more participants toward the exit. This is how localized policy shifts turn into global liquidity events. What makes this moment particularly fragile is timing. Many global markets are already priced for perfection, with valuations built on the assumption that financial conditions will remain loose and predictable. The forced unwinding of yen-funded trades introduces tightening without a central bank announcement, without a press conference, and without warning. Liquidity simply recedes. Asset correlations rise, and diversification fails when it is needed most. The true risk is not that carry trades unwind, but that markets have forgotten how dependent they are on them when the funding source that underpins global risk-taking begins to reprice. The adjustment does not stay confined to currency desks or bond traders. It bleeds into every asset class, reminding investors that leverage is only invisible when conditions are calm and brutally visible when they are not. The concept of a global margin call is often misunderstood as a dramatic, sudden event, but in reality it begins quietly, deep inside balance sheets and risk models. Rising yields in Japan set this process in motion by driving bond prices lower, particularly at the long end of the curve where duration risk is highest. When bond prices fall, the value of collateral declines, and in a highly leveraged financial system, collateral is the oxygen that keeps positions alive. Once that oxygen thins, even well-structured portfolios are forced to react, not because the underlying thesis has changed, but because the math no longer works. This is where the true hook lies. Margin calls do not ask for opinions, forecasts, or conviction. They demand cash. Institutions that borrowed against low volatility assumptions suddenly face higher haircuts and stricter funding terms. Clearinghouses and prime brokers respond automatically, raising margin requirements to protect themselves. This sets off a chain reaction in which investors must either post additional capital or liquidate assets immediately. In stressed conditions, liquidation is the faster option, and SPI becomes the enemy of price stability. The danger is amplified by the interconnected nature of modern finance. A bond sold to meet a margin call depresses prices further, triggering new margin calls elsewhere. What starts in Japanese government bonds can quickly migrate into US Treasuries, equity index futures, corporate credit, and even commodities. Markets that appear unrelated suddenly move together, not because their fundamentals align, but because they share the same balance sheet constraints. This is how correlations spike and diversification fails at precisely the wrong moment. Another overlooked dimension is leverage hidden outside traditional banking. Hedge funds, private credit vehicles, and derivatives markets operate with embedded leverage that is often underestimated during calm periods. These structures are designed to maximize returns when volatility is low, but they become fragile when funding costs rise and price swings increase as Japanese yields climb. Volatility expectations reset and models recalibrate in real time. Positions that once fit neatly within risk limits are suddenly non-compliant. What makes this environment especially unstable is the absence of a clear policy backstop. Unlike past crises triggered by explicit tightening cycles, this stress emerges from market-driven repricing. There is no single announcement to reverse, no simple intervention to halt the process without broader consequences. Central banks can provide liquidity, but they cannot force investors to ignore rising yields or declining collateral values. The global margin call dynamic thrives on speed and opacity. By the time stress becomes visible in headlines, much of the damage has already occurred, through forced selling and balance sheet contraction. This is why rising Japanese yields matter so deeply. They introduce pressure into a system built on leverage, and once leverage is tested, the outcome is rarely contained, orderly, or forgiving. Japan's role in the global financial war system is often underestimated, not because it lacks influence, but because its influence has been quiet and persistent. As the world's largest creditor nation, Japan has accumulated vast holdings of foreign assets over decades, ranging from US treasuries and European sovereign bonds to equities, infrastructure, and private credit. These investments were made under a simple and powerful logic. Returns abroad were consistently higher than anything available at home. When domestic yields were pinned near zero, capital had little reason to stay. That logic has now been challenged, and when incentives change for the largest pool of global savings, markets everywhere feel the shift. Rising long-term Japanese yields alter the relative attractiveness of domestic versus foreign assets. A 3.5% yield on 30-year government bonds may not sound extreme in isolation, but in the Japanese context, it represents a meaningful alternative to foreign risk. For institutional investors such as pension funds and insurers, this matters profoundly. These entities prioritize stability, currency alignment, and duration matching. When they can earn higher returns at home without currency risk, the rationale for holding large foreign positions weakens. Capital does not need to flee all at once to cause disruption. Even gradual repatriation can exert sustained pressure on global markets. The hook many investors miss is that repatriation does not occur in a vacuum. When Japanese institutions sell foreign assets to bring capital home, they influence prices, yields, and currencies simultaneously. US Treasury yields can rise as demand softens. Equity markets can face selling pressure unrelated to corporate fundamentals. Foreign currencies can weaken as yen demand increases. These moves reinforce one another, tightening global financial conditions without any single central bank taking action. This process also exposes a deeper vulnerability. Global markets have grown accustomed to a steady inflow of Japanese capital. That inflow has helped suppress yields, support asset prices, and stabilize funding markets. When the flow slows or reverses, the absence is felt more sharply than the presence ever was. Liquidity thins, bid-ask spreads widen, and price discovery becomes more volatile. Investors accustomed to deep, resilient markets suddenly encounter fragility. There is also a strategic dimension. Japanese investors are among the most conservative in the world, and when they begin to reassess risk, it sends a powerful signal. Their actions reflect long-term thinking rather than done short-term speculation. If these institutions decide that domestic yields now justify a rebalancing, it suggests a broader shift in confidence about global returns and risks. What makes this moment particularly sensitive is the scale involved. Japan's overseas assets amount to trillions of dollars, and even small percentage adjustments translate into large, absolute flows. Markets are not built to absorb such shifts smoothly. When the world's largest creditor starts to favor home over abroad, the global system must recalibrate, and that recalibration rarely occurs without volatility. Japan's fiscal position has long existed in a delicate balance sustained by one crucial factor: extraordinarily low interest rates. With a debt-to-GDP ratio that ranks among the highest in the world, Japan was able to carry this burden not because the debt was small, but because the cost of servicing it was minimal. For years, near-zero yields transformed what would otherwise be an unsustainable fiscal profile into a manageable one. As long as borrowing costs remained suppressed, the system appeared stable. The rise in long-term yields disrupts that balance, and when the cost of money rises, fiscal mathematics becomes unforgiving. Higher yields immediately translate into higher debt servicing costs over time. Even modest increases at the long end of the curve can have outsized effects when applied to an enormous stock of outstanding obligations. This is where the hidden pressure builds. Governments do not feel the pain all at once, but markets anticipate it well in advance. Investors begin to question how future budgets will absorb rising interest expenses without either higher taxes, reduced spending, or increased issuance. Each option carries economic and political consequences, and none are neutral for growth. The hook here is that fiscal stress does not need a crisis to become destabilizing. It emerges through confidence. When investors perceive that a government's debt trajectory is becoming harder to manage, they demand higher yields as compensation. Those higher yields then worsen the fiscal outlook further, creating a feedback loop that can accelerate quickly. This dynamic has appeared in many sovereign debt episodes, and Japan is not immune simply because it has avoided them in the past. What intensifies the challenge is demographic reality. Japan's aging population places increasing demands on public spending through pensions, healthcare, and social services, even as the workforce shrinks. This narrows the margin for fiscal adjustment precisely at the moment when financing costs are rising. The ability to grow out of debt becomes constrained, making fiscal discipline more difficult to achieve without slowing the economy. There is also an implicit reliance on domestic investors to absorb government debt. For decades, this arrangement worked because households and institutions accepted low yields in exchange for stability. As yields rise, that stability comes at a higher cost, and the government must compete more aggressively for domestic savings. This competition can crowd out private investment, reducing long-term growth potential and further complicating fiscal sustainability. The broader implication is that Japan's fiscal model was built on an assumption that is now under review, that interest rates could remain exceptionally. Central bank credibility is built not on promises, but on outcomes, and Japan now stands at a defining crossroads where those two are colliding. For years, the Bank of Japan cultivated the image of absolute control over the yield curve, reinforcing the belief that it could suppress long-term rates regardless of market pressure. Yield curve control was not just a policy tool, it was a statement of authority. Markets adapted to that authority, embedding it into pricing models, leverage strategies, and long-term assumptions. When yields rise despite that framework, credibility is no longer theoretical, it is tested in real time. The tension lies in the narrowing range of viable choices. If the central bank intervenes aggressively to cap yields, it must expand its balance sheet further, potentially weakening the currency and intensifying imported inflation. That path preserves one market stability but risks undermining confidence in the currency itself. If, on the other hand, the bank allows yields to rise in the name of normalization, it exposes the financial system and public finances to stress that has been suppressed for years. This is the hook. Every option now carries visible costs, and markets are quick to exploit perceived hesitation. Credibility also depends on consistency. Shifting guidance, subtle policy adjustments, and ambiguous communication can amplify uncertainty rather than reduce it. Investors are highly sensitive to signals from the Bank of Japan because its actions influence not only domestic markets, but global funding conditions. A single policy recalibration can alter currency dynamics, capital flows, and risk appetite worldwide. In this environment, even silence becomes a signal, and every move is scrutinized for what it implies about control and confidence. Another challenge is timing. Central banks are most effective when they act ahead of market pressure, not in response to it. Once yields begin to move on their own, intervention becomes more costly and less convincing. Markets start to question whether policy is leading or following, and that distinction matters. The central bank perceived as reactive invites speculation, testing, and volatility. Credibility erodes not in dramatic failures, but in small, repeated concessions. There is also a global dimension to this test. Other central banks are watching closely because Japan represents the final frontier of ultra-accommodative policy. If control weakens here, it reinforces the idea that no central bank can permanently suppress market forces. That realization reshapes expectations everywhere, reducing the effectiveness of forward guidance and increasing the risk premium demanded by investors. What makes this moment especially sensitive is that credibility, once lost, is difficult to restore. It requires sustained alignment between policy intent and market outcomes. As Japanese yields rise, the Bank of Japan is being measured not by its words, but by whether markets continue to believe in its ability to define the boundaries of risk. That belief, more than any single policy decision, will determine the stability of both domestic and global financial systems. So let me leave you with this. Japan's 30-year yield at 3.5% is not a headline to scroll past. It is a warning flare. It tells us that the cost of time itself is rising, that leverage is being tested, and that global markets are far more interconnected than they appear on the surface. This is how systemic shifts begin, not with crashes, but with yields quietly moving where they are not supposed to go. In the months ahead, volatility will not be a surprise, it will be the consequence. Capital will demand discipline, liquidity will demand respect, and those who mistake this for a regional issue will learn, once again, that in global finance, there are no isolated events. When Japan moves, the world recalculates. And right now, the recalculation has begun.